Hi, my name is Tristan Crook.
My name is Adam Starr.
And I am Maddie Whalen.
And we're giving our equity valuation over Apple. We're giving it a buy rating with a value of $252.
Apple's headquarters are located in Cupertino, California, and they were founded on April 1st, 1976. In 1996, the market share fell dramatically, and after the fall, Apple brought back Steve Jobs, one of the original founders, and created a partnership with Microsoft. Apple's fourth quarter 2018 goals are revenue between $60 billion and $62 billion, gross margin between 38 and 38.5%, operating expenses between $7.95 billion and $8.05 billion. Apple's geographical exposure is not only in the United States, but also internationally. They are currently announcing that they have research and development centers located in China. Apple is a part of the technology sector and consumer electronics industry. Opportunities for the technology industry for growth are in cloud computing, flexible consumption, cognitive computing, user-friendly tools, APIs and apps, and data. The three competitors that we chose to be Apple's peer group would be Sony, Microsoft, and Samsung. Sony's market capitalization is $75.1 billion with a net income of $5.7 billion. Microsoft's market capitalization is $859.9 billion with a net income of $16.6 billion. And Samsung's market capitalization is $270.7 billion and a net income of $40.5 billion. And these numbers were taken from Morningstar Direct.
For Apple's financial analysis, most of their ratios were fairly comparable to their peers. So some of those notable differences begin with ROA and ROE, both are above their peer averages, as you can see on the graph on the right, both of which exemplify higher profitability. The next couple ratios are the current and quick. Both are below their peer averages, and both of these ratios are often a factor in determining credit worthiness, which is interesting because Apple has a 73% debt to equity ratio compared to their peers is of 50%. That number is nothing to be too concerned of right now, but something to keep an eye on in the future. And finally, their cash conversion cycle is more favorable than their peers. They collect on their receivables much sooner than their peers, and they take a lot less time to sell their inventory than their competitors. And they finally pay off their payables in a strategic way, slower than their peers are.
In these two charts, you can see both the 3, 4, and 5-year returns for Samsung and Apple and its peers, as well as the S&P 500 and the Dow Jones. Both Apple and its peers outpace the S&P 500 and the Dow Jones over those 3, 4, and 5-year spans. In this chart, you can see a growth of $100 invested in Apple as well as with its peers. Starting in about October of 2016, Apple and Microsoft separated themselves from the pack and started trending at a much higher growth rate. As for Apple's business segment, they rely heavily upon the iPhone, and they captured 12% of the smartphone market. iPhone is their highest grossing product due to its high switching costs, which include iTunes, FaceTime, iMessage, and the Apple App Store, which are not available on competitors' devices. Apple also has a vast diversified product array, which includes the iPhone, the iWatch, and the MacBook, their three most popular products. They also bring in subscription revenue. Last year, they brought in over $9 billion in subscription revenue, which can be attested to iMusic, iCloud, and Apple Pay. For the intrinsic valuation of Apple, we use both a dividend discount model and the free cash flow to the firm model. For the dividend discount model, we use a single-stage growth rate. As you can see by the chart, Apple's dividend growth rate has been very constant over the last 4 years, averaging 9.84%, which is the growth rate we used. The required rate of return of 10.92% was calculated using the capital asset pricing model. The resulting price estimate was $250.81. For the free cash flow to the firm model, we used a weighted average cost of capital of 6.06%, which we calculated ourselves, a first stage growth rate of 5.2%, which is a 5-year estimate of the growth rate from Morningstar Direct for Apple, as well as a growth rate of 3.22% indefinitely after that 5-year span, which is the growth rate of the gross domestic product of the United States historically. The resulting price estimate equated $289.94. For the relative valuation for Apple, we used industry multiples. For the price to earnings multiple, we used 19.02, a growth rate of 27.69%, which is a 1-year growth estimate for Apple for its earnings found on Yahoo Finance, which resulted in a price estimate of $225.13. For the price to sales industry multiple, we used 3.33, a growth rate of 5.2%, which is the same growth rate found in the free cash flow to the firm model, which resulted in a price estimate of $171.27. For price to cash flow, we used an industry multiple of 21.63, a growth rate of 10%, which is a long 10-year growth rate projection on Morningstar Direct for Apple, which resulted in a price estimate of $212.31.
Based on the group's intrinsic and relative valuations of Apple, we would give it a buy rating. Due to peer comparability issues, the valuation relied heavily upon the intrinsic price estimates, which we gave a 75% weighting to. When paired with the relative valuations, which was 25%, the group concluded that the stock's fair value is around the $252 range, signifying that it is underpriced. Thank you.